Welcome to our tutorial series. Today we're going to look at the ticking tax time bomb. What exactly is that? Well, essentially it's what you owe when you die. Did you actually know that you'll have to pay a final tax bill upon your death? Do you know how much that's going to be? What we're going to do is we're going to take an example of the average Canadian with average Canadian assets and see what they would actually owe upon their death. We're going to start off with the principal residence, or your house. Let's assume we purchased it for $100,000 and today it's worth $800,000. Good news is there's zero taxes because of something called the principal residence exemption. Then we're going to take a look at an investment property. Let's say we purchased this property for $300,000. Market value today, $600,000. Taxes owing, $67,500 of what we call capital gains tax. Well, what exactly is a capital gains tax? Well, it's a lower tax than you would either pay on employment or interest income, and it applies to non-registered investments such as stocks and mutual funds, and capital property such as a cottage or an investment or income producing property. Let's take a look at a calculation, and going back to our investment property with the purchase price of $300,000 and a market value at the time of death of $600,000. Now we also have to take a look at a term called deemed disposition. What exactly is that? Although the property is not necessarily physically sold, a deemed disposition occurs. So it's treated as if the deceased sold the property while they were still alive. So anyway, we got a profit of $300,000. Capital gains inclusion rate of 50% is $150,000. Well, that's a fancy way of saying that the first half of the profit is tax-free and the other half of the profit is applied against income. So the taxes due at our marginal tax rate of 45% is $67,500. So going back to the example, now we introduce a cottage into the equation with a purchase price of $200,000 and a market value of $6,000. Taxes owing are $90,000. Non-registered investments of $50,000 such as stocks or mutual funds, market value of $300,000 and taxes owing $56,250. RSP, $200,000 purchase price, market value of $500, taxes owing $225,000. Why so much? Well, because we don't tax the profit on the RSP. The entire amount of the RSP, or the entire value, is actually taxed. So if we look at the final tax bill, our purchase price was $650,000. Our market value of everything we owe was $2.8 million. Taxes owing $438,750. So we face two challenges with this. The first is, what if the amount increases? Second, how the final tax bill is actually financed. What if the amount increases? Well, this is a challenge often faced when you're doing estate planning. And that final tax bill is going to be dependent upon market conditions, assets accumulated, and time of death. A couple of options to consider: you can enact an estate freeze, or you can transfer assets while you're alive, also known as an inter vivos transfer. These options, though, will be dealt with in a future tutorial. They are quite complex and they deserve their own time. If you do need immediate information, contact us at inquiries@longowealth.com or call us at 905-366-3841. So how do we finance the final tax bill? We have four options. The first is we can use investments, assets, cash, RSPs, etc. Well, what if it's a good time? What if it's not a good time to sell them? What if the market is down? Now, you would have made this decision to sell these assets, and under these circumstances, if you were alive, I'm sure you don't want your executor to do that on your behalf after you've passed away. Option 2, use some real property, a house, an investment property. The challenge there is that real estate is not a liquid asset. It may take too much time to sell, or we may be in a situation in which there's a credit freeze, and then you don't have enough buyers out there because they can't obtain financing, and as a result, you can't get the purchase price or the sell price that you're looking for. What about using your savings? I don't like this option very much, because you have your hard-earned money just sitting in a bank account doing absolutely nothing for you, and you can't touch it. Is that what you worked to put aside money for the government? What is another option? My favorite option is the use of life insurance. Why don't we transfer the risk of the taxes from you to the life insurance company? This way you can reduce your tax bill significantly. Well, let's review. Going back to our example, $438,750 in your final tax bill. In this scenario, the estate may not be worth $2.8 million. However, $438,750 actually belongs to the government. What if this amount was held in cash at a bank doing nothing for the owner? So the solution: why don't we use a life insurance policy to fund this? Let's assume it's a 50-year-old male, non-smoker, average health. Assume for the sake of illustration that the tax bill does not increase over the course of the next 50 years. What do? Well, the annual cost of a $438,750 Term 100 life insurance policy will cost you $4,471 per year in premiums. So taking a look at a chart over here, if we have the policy for 1 year, we invest $4,471, and the benefit we derive from it is $438,750. If we actually live another 50 years, we'll have paid $223,550, yet our benefit is still higher at $438,750, still worth the investment. So as a result of transferring the tax burden to the insurance company, your tax bill has been reduced by anywhere between 49% to 91%. So in closing, we do have a final tax bill to pay, and in my opinion, the best way to address that tax bill is to transfer the risk and the liability to an insurance company. Thank you very much for your time, and be on the lookout for our other tutorials.